Hello. Today I'm going to talk to you about an alternative way of valuing the equity of a company, um, the dividend discount approach. Um, we have discussed one other method, the discounted cash flow approach, and I want to sort of compare those for you. If you recall that the formula for the discounted cash flow approach to equity valuation could be reduced to a growing perpetuity if we assume some growth rate. And the benefit of that is that we don't then have to forecast cash flows all the way out to forever. We can simply say that it's, you know, some cash flow growing at some rate. And if the main thing I want to draw your attention to is in the the discount cash flow model, the number we use for cash flows at the end of year one are our estimate of free cash flows to equity at the end of that year. In the dividend discount approach, everything else looks the same except for we look at the next year's dividend rather than looking at free cash flows to equity. The key reason that somebody uses this is that dividends tend to be an easily observable number. The company does a good job of providing information about what they think future dividends will be and so forth. There's generally less uncertainty about what the future dividend rates might be. But quite frankly, when I'll go through an example here, I'm not sure that while that may be true in the short term, it's not particularly true in the long term and may not be a particular benefit. Um, so I'm doing this example using Disney again. If you'll recall from the last, I don't know why I did that. If you recall from our last example, I went to Yahoo and found out that Disney stock was trading at about $108 a share. I've gone to Yahoo and found that the dividend for next year, the forward dividends assumed to be $1.56. I can show you that real quick. Going to Yahoo, looking under statistics, there's usually information on dividends, and so usually they report two kinds of dividends. There's the forward dividend and the trailing dividend. Trailing is what happened in the past. Forward's what you expect to happen over the next year in terms of the forward annual dividend, and we want the rate, not the yield, and so we would use the 156 because remember we want the cash flows a year from now, not the cash flows now. So buck 56, we're using the same cap in discount rate as before, 632, and we're going to go through the same process of solving out for what the implied growth rate of the dividend is. So again, got the $1.08, trailing dividends 142, but we don't care about that. We care about the forward dividend. Discount rate, we've got the estimated dividend growth rate, if I just took 156 over 142, is 9.86%. Keep in mind that's the growth rate for the next year, it's not the growth rate forever. So while it's an interesting number, it's not really the number we're after. We use the same discounted perpetuity model, so it is cash flow at time one. Don't need the gross up anymore because we've got the cash flow at time one. So we're going to stick in, again, just a plug. We'll put 5% as the growth rate. This time we're working in terms of stock price instead of total market cap. Again, all of the numbers are the same other than if you were doing them with market cap, you would have divided by the 1.59 billion shares outstanding. And that's just a scaling factor. Everything else works the same. So we're just going to do it in terms of share price. Share price is about $1.08. The dividend today, change that. Is 142. Good information, but we don't need it. Dividend next year. We're just going to grab the I can't really type apparently. We're just going to grab the amount that we typed in up here. Again, the implied discount rate from all of our CAPM stuff is this. When we plug all of that in, we get a stock price of $118. That is, our current stock price is $10 lower than that. Here's our difference. And so we need to solve for the right growth rate. Going to use the exact same process as before, what if analysis, goal seek. We're going to set this difference to 0 by changing the value of the implied growth rate. It solves very quickly and comes back and says implied growth rate of 4.88%. You can see that's half of what the growth rate for next year is. There again, part of the logic of that is that this would be the implied growth rate forever. And I'm not sure that forever you could afford to grow your dividends by 10% every year. Same as before, we've done a sensitivity analysis to see how sensitive the valuation, the $108 value is, to us being wrong in either the growth rate or the discount rate. So if we'd set, again, what we have is we've just put in the number that we had before plus whatever the change is. We've done the same thing down here. You've got the current price of the stock, just read it from over here. You've got next year's dividend, which we've just read from over here. And you got the theoretical value down here, which is just the next year's dividend divided by the discount rate minus the growth rate. So if I go in here and I say, well, let's just make this 0.1, so instead of 4.88, it's 4.98. You'll see that drops the value of the stock, or it raises the value of the stock, sorry, because our growth rate went up. So increased growth rate raises the value of the stock by $8. Goes from 108 to 116. Last time when we moved things for the DCF, when we moved them by 0.1%, it only influenced the value by $2. So this model seems to be quite a bit more sensitive to these assumptions than the prior approach, the DCF approach. Now I can do the same thing. I'm going to expect a similar result here. Here that causes about a $7 change, this kind of drop. And again, if you went opposite directions on these, I'm assuming you would get similar result. Let's see. So this is kind of interesting. In this case, it seems to be that when you put them in the same direction, they offset each other. I guess that's what the last one did too. So when you put them in opposites, though, that causes a problem. Again, main aha here, this model seems to be much more sensitive in terms of predicting the share price to the assumptions about the discount rate and the growth rate than the other model. And I covered that kind of in here. Again, the same kind of direction and results, and clearly it's a lot more sensitive. So you've got two different approaches to valuing right now, the discount cash flow and the dividend discount. And somehow we have to wrap our head around why they both make sense, or do they both make sense? So remember that the discount cash flow model values equity based on the cash flows to which the equity owners are entitled, regardless of whether it's distributed to them or not. And so the thought would be that eventually they're going to be able to, that those will be distributed. But either way, they are entitled to them, and so it's sort of a clean approach. The dividend discount model only considers the cash flows once they're distributed. Theoretically, you could make the argument that at some point in the future, the firm will run out of growth opportunities and become what we refer to as a cash cow. A cash cow is a company that you don't keep investing in it, and it doesn't invest in any new projects. It simply reaps the cash flows from the projects it has. And so, since there's no need for additional investment, if the company retained all of its free cash flows to equity, you just have this cash building up and not doing anything, and that's not good for anybody. And so you would assume that instead cash cows start paying dividends. And in fact, they start paying dividends to sort of draw down their cash and their retained earnings, um, to more acceptable levels for a company that doesn't need money for investment. And so, given that, at some point in the future, you would assume that free cash flows equal dividend discount or the dividend, and the two valuation approaches would use the same input and get the same result. Um, we can sort of see that now. If you think about it, the dividend discount um, is saying that the dividend will grow about 4.8%, 4.9. Whereas the discounted cash flow says that free cash flows to equity will barely grow at all. It'll be like 0.2%. And so, in some sense, what that suggests is that earnings are not growing very fast. Free cash flows are not growing very fast. And at some point, perhaps they don't grow at all. And at that point, maybe the firm does not need to continue making new investments, or it doesn't make sense for them to make new investments, and they will start funneling more of their cash into dividends. When they do that, obviously, that means that they have to, from between now and then, increase the amount of the dividend. And so they've got time for a longer period of time to increase that dividend, and it'll grow at a much faster rate. When we think about why somebody might use the dividend discount approach instead of the discounted cash flow approach, first thing that we want to think about is, what does it really help or hurt with? And so, from an issue standpoint, you still can't observe the growth rate of dividends or the discount rate here. You do know something about the dividend growth rate in the near term, based on those projections, and in fact, they do sometimes give you information for maybe a 5-year target rate or target growth rate for dividends in a company. But again, what you need are growth rates, sort of a average growth rate forever, and they can't provide you with that. The other issue that comes from using that model is that it doesn't really explain the value of stock for firms that do not pay dividends. Think about it. If you've got a number of stocks that don't pay dividends, I was looking recently to see sort of the statistics, and they break the let's just call it the S&P universe into large cap, medium cap, and small cap. Large cap are firms that are 5 billion in market value or higher, somewhere around that. Medium is about 1.5 to 5 billion in market cap, and small is about 4 million to 1.4 billion, or 400 million, sorry, to 1.4 billion. And while it's true that about 85% of the large cap companies pay dividends, 80 to 85%, and 70 to 75% of the medium cap companies do, less than 50% of the small cap companies do. And there's a lot more small cap companies. The medium and large cap together are less than 1,000 companies. And so, even in that universe, you still have about, call it 300 companies, 200 to 300 companies that don't pay dividends. So this model could not help you look at and evaluate the stock price for those companies at all. However, when you look at the two models together, you do get some insights. Again, the discount dividend model, some people like it because it really reflects both the amount and the timing of cash flows that the investor will get when the investor gets them. And so rather than looking at this money that they may never get, or that they may not get for a long, long time, It focuses in on the cash that they know they're going to get. And so some people find an intuition to that. The growth rates, again, between the dividend discount model and the DCF approach, they do tell us some things about, kind of where we are in the process with the company of moving from a growth company to maybe a cash cow type company. Dividends don't signal that as strongly as free cash flow. A company can be um, growing in terms of dividends, but not growing in terms of free cash flow to equity. And quite frankly, that doesn't matter. If it's not adding any new free cash flows to equity year over year, then the dividends growth is really just them saying it's time to start paying out some of what we've accumulated in our war chest, if you will. Now, also interesting, the dividend discount model predicts that firms that pay higher dividends have a higher um, stock price, basically value of equity, than those paying lower dividends, all other things being equal. So if you had two firms that basically had the same beta, and one had higher dividends and one had lower dividends, you would expect that the one with higher dividends would be valued more highly. Unfortunately, we do not find that this is consistent with what we see in the market overall. And so, if we look across all companies that pay dividends, we do not see that companies with similar betas, that the value of their stock differs because of the dividend. Um, so, not really supported by that. However, we do see that this tends to be consistent if you just look at what we would call blue chip firms, sort of the very large, mature, large in terms of market cap, mature firms, which are essentially cash cows. They don't have a lot of variability. There's not really any real growth expected in them. And so their dividends will closely mimic their free cash flows to equity. And you do see sort of that relationship. And so while not a perfect model, maybe an okay model for mature dividend paying stocks, since that represents a lot of the market cap in the market and a lot of what some investment portfolios are comprised of, maybe not a bad sort of approximation, what we would call a proxy model for the discounted cash flow model in those very specific situations. So hopefully you find this useful. Thanks for listening.